Hello everyone, welcome back to another video. My name is Ali. I'm a certified financial planner based out of Toronto, and let's talk about finance. In today's video, we're going to talk about risk and how that's calculated when it comes to your investments. So let's get started. So risk is essentially calculated based on the volatility of the investment. Certain investments have certain risk categories. So let's take a look at some very simple examples. If we take a look at GICs have little to no risk associated with them. And the reason for that is because there's really no volatility. The only thing you really have to worry about with a GIC is making sure that you actually receive the interest that you're supposed to. And in most cases, you're going to, because these GICs are usually issued by big financial institutions. So that's why it's considered to be little to no risk associated with a GIC. Next, let's take a look at bonds. Bonds tend to be a little bit more volatile because the prices of the bonds can change over time. Now, let me explain what a bond is. Say, for example, if you need a loan, where do you tend to go? You tend to go to a lender that will provide you with that loan, and essentially they'll allow you to borrow that money and you have to pay it back, but you have to pay interest on top of it. Now, a bond is essentially something that's issued by either governments or corporations where when they need to borrow money, they'll issue a bond where you provide them the money, but they have to return that money back to you and they have to pay you interest. There's a reason for why bonds are considered to be low risk investments or lower risk investments. And the reason for that is because a lot of times these bonds are provided by big financial institutions. They're provided by big corporations, and they're also provided by the government. Now, not all bonds are treated equal. And the reason for that is because all of these different bonds are issued by different organizations, by different companies, where each of them have their own credit history, their own credit score. And essentially, based on the way that these investments are distributed, some of them are considered to be a little bit higher risk versus others, but they're still considered relatively low risk because the volatility is not very high. Now, let's take a look at stocks. Stocks tend to be considered high risk investments. And the reason for that, if we take a look at the stock market, it tends to go up and down on a daily basis. Now, some stocks are considered to be higher risk than others, but primarily what you'll see is stocks themselves are considered to be high risk. This is a very easy, quick overview to understand what is considered to be higher risk and what is considered to be lower risk. Now, most people are not going to be investing into individual bonds or individual stocks. Most people are going to be in a portfolio, whether it's an ETF or a mutual fund. And in these cases, the way that these mutual funds or ETFs are put together, that the risk is actually managed within the portfolio. And the reason that this is the case is because a lot of times in ETFs and mutual funds, it's a basket of investments. So there's a variety of different stocks, there's a variety of different bonds, and there's a variety of different other types of investments that have various levels of risk. So essentially, a mutual fund or an ETF that has more bonds is considered to be a lower risk mutual fund. A mutual fund or an ETF that has more stocks in it will be considered higher risk. So this is why there's so many different types of mutual funds that are out there and ETFs that are out there. And it's because the way that risk is managed within those products, it really, really makes a difference with regards to your return. Now, typically what you'll find is if you take on higher risk, there's the potential for higher return. It does not guarantee that you're going to get a higher return. There's the potential for higher return. And that's just based off of what we've seen based on history, with the way that the stock market has been and the way that these investments have performed over time. If they have more exposure to bonds, they tend to have lower risk, which means that the potential for return is slightly lower versus the other baskets of investments. So this is actually very important to understand because when you're going to invest, there's a few things to really keep in mind, especially if you're investing for retirement purposes. The idea here is if you have over 10 years before you actually need to access the money, it's not a bad idea to take a look at some investments that have a little bit of higher risk. Now, for some people, they don't necessarily like the volatility, but the volatility over time ends up usually performing better for you. So say for example, you're in a portfolio that is considered a balanced portfolio, which is, let's say half of the portfolio is bonds, the other half is stocks. What you'll find is if stocks take off, then you may end up getting an 8% or 9% rate of return. Whereas if you're in a portfolio that is 100% invested in stocks, in that same time period, you may have a 12, 13, 14, or even 15% rate of return, if not higher, depending on what that basket of stocks is. Now, of course, it's easy to take a look at some of these baskets of investments and say, well, of course, I'm going to go with something that's a little bit higher risk because the returns are better. It's important though to understand that when markets are not doing well, and we saw this back in the early 2000s, we saw this back in 2008, we also saw this a little bit during COVID, and again, we saw some smaller corrections along the way as well. So the most recent would have been 2022. In situations where you have a higher risk portfolio, you tend to see a bigger decline in your investments in those particular years. So say for example, in 2022, you had a portfolio where it was considered higher risk. Your investments were probably down anywhere between 10 to 20%. Whereas somebody who had a portfolio that was considered lower risk or medium risk was maybe down 5 to 10%. This is really why it's important to understand the risk factor, because of course everybody wants to make as much as possible, but you also want to make sure that you're protected when the markets go down, because we know that the markets will go down. It's just a matter of when. Now keep this in mind. The period in which markets are down versus when they're gaining and when they're going up is a significantly shorter period of time. So say for example, you have 15 years to retirement. This is still a good time for you to have money in higher risk investments because you still have a long time horizon. Let's say you have a short time period to retirement. It still might not be a bad idea to have a little bit of extra risk when it comes to your investments. Say for example, you have $500,000 towards retirement. What I tend to tell my clients is if you have $500,000, it might not be a bad idea to have a portion of that $500,000 into higher risk investments, because you're probably not going to need that money for the next 5 to 10, maybe even 15 years. The one thing though that I would probably focus on is trying to structure the investments in a way where the money that you know you're going to need in the short term, put that in lower risk investments. Put that into something that's a little bit more stable because you know you're going to need access to that money. The remaining amount of money that you have in the account, it's okay to put it in something that's considered a medium risk because you know that you're not going to need that money for at least the next 5 years, maybe even 10 years from now. But slowly what you're going to do is you're going to slowly start to sell off some of those higher risk investments, and you're going to slowly transfer those into the lower risk investments as you get closer to actually needing to use that money. Now this is a great way for you to manage the risk that you have, but make sure that you're not exposed with too much risk with at least the money that you know that you're going to need. This will also give you an opportunity to continue to grow your money at potentially a higher rate of return. Instead of maybe 5% rate of return, maybe you're getting 7 or 8% rate of return, and this will allow you to continue to grow your money long term, and it'll actually allow you to have more money long term that maybe you can use, or maybe you could pass on to the next generation or to whoever it is that you want. This is definitely something great to consider when you're building out your portfolio, and how that portfolio will change for you as you get closer and closer to retirement. So there you have it, guys. Those are some things to consider when it comes to risk, when it comes to your investments. If you like this video, please leave a like down below. And also if you have any questions, leave those in the comments, and I'm more than happy to answer any questions that you guys have. Also, if you learned anything from this video, please share it with your friends and family. At the end of the day, if you learned something from this, I'm sure they will too. It also helps me grow out this channel to allow me to continue to make these videos, to make this information readily available to people like yourself. As always, guys, stay safe, take care, and we'll see you guys in the next one.